After Bitcoin, Ethereum is frequently referred to as the second most popular cryptocurrency. However, unlike Bitcoin and most other virtual currencies, Ethereum is intended to be much more than a medium of exchange or a store of value. Ethereum, on the other hand, refers to itself as a decentralized computing network based on blockchain technology. Let's take a look at what that means. The Financial and Investment Wisdom channel is all about making better financial decisions. If you're looking for financial literacy, growth investing, trading, or want to improve your finances, this could be a great one for you. What exactly is Ethereum? Ethereum is one of the thousands of cryptocurrencies that have sprung up in recent years. Ethereum, the brainchild of 8 co-founders, made its debut in 2015. The cryptocurrency or platform is known as Ethereum, and the individual unit is known as Ether. Ethereum is managed and tracked by a blockchain, which is a decentralized computer network or distributed ledger. Consider a blockchain to be a running record of every transaction that has ever occurred in cryptocurrency. Computers in the network validate transactions and ensure data integrity. This decentralized network is part of what makes Ethereum and other cryptocurrencies appealing. Users can exchange money without a central intermediary, such as a bank, and the currency is nearly autonomous due to the lack of a central bank. Ethereum also enables users to conduct transactions virtually anonymously, even if the marketing is publicly visible on the blockchain. While the entire field is called currency, it may be more beneficial to consider crypto as a token that can be spent for a specific purpose enabled by the Ethereum platform. The coin, for example, enables functions such as sending money and buying and selling goods. However, Ethereum is capable of much more, and it can also serve as the foundation for smart contracts and other applications. What is the origin of Ether coins? There was approximately 117 million Ether in circulation as of August 2021. Furthermore, while new coins can be mined, the total annual issuance is limited. This is in stark contrast to Bitcoin, where a maximum of 21 million coins can be mined, and new allotment becomes increasingly complex each year. Furthermore, it contrasts with Dogecoin, where issuance is entirely unlimited. The computers on the network mine Ether coins and other cryptocurrencies where they use mathematical calculations to unlock coins or fractions of coins. That setup, however, is changing. To mine new coins and validate transactions, both the Bitcoin and Ethereum blockchains employ proof of work. It is a costly, energy-intensive, and time-consuming process that has the potential to clog the network. As a result, the minds behind Ethereum have decided to switch to a proof-of-stake system dubbed Ethereum 2.0. Miners will find it challenging to generate new coins under the new system. Instead, those who own the currency stake their crypto holdings to validate transactions. Stakers may lose money if they verify transactions that do not follow Ethereum's rules. It is expected that the switchover and transaction fees being burned, permanently destroyed, will result in the fewer Ether in existence and a deflationary spiral, causing the cryptocurrency to soar. What is the difference between Ether and Ethereum? Ether can be used in financial transactions, as an investment, or as a store of value. Ethereum is the blockchain network where Ether is stored and traded. However, as previously stated, this network provides a variety of other functions in addition to ETH. These can be simple fund transfers, but they can also be complex transactions that do anything from exchanging assets to taking out loans to purchasing a piece of digital art, says Boaz Avital, Anchorage's head of product. The Ethereum network processes and stores the transactions. The Ethereum network can also be used for data storage and the execution of decentralized applications. People can host applications on the Ethereum blockchain rather than on a server owned and operated by Google or Amazon, where only one company controls the data. This gives users control over their data and allows them to freely use the app because there is no centralized authority managing everything. Self-executing contracts, also known as smart contracts, are among the most intriguing use cases for Ether and Ethereum. Two parties agree to deliver goods or services in the future, just like any other contract. Unlike traditional contracts, no lawyers are required. The contract is coded on the Ethereum blockchain by the parties. When the conditions of the agreement are met, it self-executes and delivers Ether to the appropriate party. The advantages of Ethereum. The existing network is extensive. The benefits of Ethereum include a tried and true network that has been tested over years of operation and billions of dollars in value trading hands, says Ken Fromm, Director of Education and Development at the Enterprise Ethereum Alliance. It has the largest ecosystem in blockchain and cryptocurrency, as well as a large and committed global community. A wide range of functions is available. Ethereum can be used to process other types of financial transactions, execute smart contracts, and store data for third-party applications, in addition to being used as a digital currency. Constant improvement. A sizable community of Ethereum developers is always looking for new ways to improve the network and create new applications. Because of Ethereum's popularity, it is often the preferred blockchain network for new and exciting, but sometimes risky, decentralized applications. Avital explains. Avoids the use of intermediaries. The decentralized network of Ethereum promises to free users from third-party intermediaries, such as lawyers who write and interpret contracts, banks who act as intermediaries in financial transactions, and third-party web hosting services. Disadvantages of Ethereum. Increasing transaction costs. The increasing popularity of Ethereum has resulted in higher transaction costs. Ethereum transaction fees, also known as gas, reached a record high of $23 per transaction in February 2021, which is great if you're a miner, but not so great if you're trying to use the network. Unlike Bitcoin, where the network rewards transaction verifiers, Ethereum requires those involved to pay the fee. Crypto inflation is a possibility. While Ethereum has an annual limit of 18 million Ether, there is no lifetime limit on the number of coins created. This could imply that, as an investment, Ethereum will behave more like dollars and will not appreciate as much as Bitcoin, which has a strict lifetime limit on the number of coins that can be created. Developers face a steep learning curve. As developers transition from centralized processing to decentralized networks, Ethereum can be difficult to learn. The future is unknown. Ethereum is still evolving and improving, and the ongoing development of Ethereum 2.0 promises new functions and increased efficiency. On the other hand, this major network update creates uncertainty for apps and deals currently in use. According to Gary DeWall, chair of Caten's Financial Markets and Regulation Group, many new validators will be required for Ethereum 2.0 to function. The question is whether the migration will be successful. There are a lot of new elements that need to come together. How to purchase Ethereum. It's a common misconception among newcomers to the Ethereum network. You don't buy Ethereum, you buy the network. Instead, you purchase Ether and use it on the Ethereum network. Because of Ethereum's popularity, it's effortless to obtain Ether. Number 1. Select a cryptocurrency exchange. To buy and sell various cryptocurrencies, crypto exchanges and trading platforms are used. Among the larger exchanges are Coinbase, Binance, and Kraken. If you only want to buy the most popular coins, such as Ether and Bitcoin, you should use an online brokerage like Robinhood or SoFi. Almost always, you will have to pay some trading or processing fee. Number 2, make a monetary deposit. To fund Ether purchases, you'll need to deposit cash, such as dollars, into your trading platform or link your bank account or debit card. Number 3, purchase Ether. After you've funded your account, you can use the funds to buy Ether at the current Ethereum price, as well as other assets. Once you have the coins in your account, you can keep them, sell them, or exchange them for other cryptocurrencies in the future. Keep in mind that whenever you sell or trade cryptocurrencies, you may be subject to taxes. Number 4, use a wallet. While you could store the Ether in the default digital wallet of your trading platform, this poses a security risk. If the exchange is hacked, anyone can easily steal your coins. Another option is to move coins that you do not intend to sell or trade anytime soon into another digital wallet or a cold wallet that is not connected to the internet for safety. Should you invest in Ether? According to DeWall, there are several reasons why you should consider investing in the Ethereum network. First, it has value and use as a virtual currency. Second, the Ethereum blockchain may become more appealing when it migrates to the new protocol. And third, demand for ETH may increase as more people use Ethereum distributed apps, he says. Aside from purchasing Ether directly, you could also consider investing in companies developing applications that use the Ethereum network. If you want assistance managing your investment, you could also invest in a professional investment fund like the Bytewise Ethereum Fund or Grayscale Ethereum Trust. However, these are currently only available to accredited investors. Before making any significant investment in Ether or other cryptocurrencies, consult with a financial advisor about the risks involved. Given the high risk and volatility in this market, even if you believe in Ethereum's potential, make sure it's money you can afford to lose. Speculators can invest directly in cryptocurrencies like Ethereum, but they can also invest in companies that may benefit from a shift toward digital currencies. Whether you're trading Ethereum, Bitcoin, or any other cryptocurrency company, it's critical to understand the risks, which include the possibility of losing your entire investment. Given the volatility and numerous risks associated with cryptocurrency, investors should proceed with caution. Those looking to get a taste of the action should not put more money at stake than they can afford to lose. We will teach you the fundamentals of financial terminology and how to get started. You'll also learn about cryptocurrency trading and investing, growth stocks, and how to be economically confident. So be sure to subscribe so you don't miss a single upload. For the time being, sayonara.